Somewhere right now in a small apartment, lit only by the glow of a laptop screen, a man is staring at a red number. It is 2 in the morning. His wife is asleep in the next room. His account, the one he swore would change everything, has just dropped another 8%. He does not close the laptop. He cannot. Something in him believes that if he just watches long enough, the market will apologize. It will not. This is not a story about bad luck. This is not a story about a rigged system, or a broker who cheated him, or a strategy that failed. This is a story about a war that 95% of traders lose every single year. A war that has nothing to do with charts, and everything to do with the person looking at them. Trading did not break him. He broke himself, one small decision at a time, and by the time he realized it, the damage was already done. This is the brutal truth nobody wants to say out loud. Most traders do not fail because they are stupid. Many of them are sharp, analytical, even brilliant in other areas of life. Doctors, engineers, software developers, business owners, people who have built real success elsewhere, walk into trading and lose everything. Why? Because the market does not test intelligence. It tests identity. It tests patience. It tests how a human being behaves when money, ego, and uncertainty collide at the exact same moment. And most people, no matter how smart, have never been trained to survive that collision. Let's start with the first wound, the one that opens before a single trade is even placed. Unrealistic expectations. Somewhere online, someone saw a screenshot. $10,000 turned into $100,000 in 3 months. A trader flexing a yacht he probably rented for the photo. And a seed gets planted, quietly, dangerously. The belief that trading is a fast lane to freedom, that if you just find the right strategy, the right indicator, the right mentor, you too can escape your 9 to 5 within a year. This belief is not harmless. It is the root of almost every disaster that follows. Because when reality does not match that fantasy, when the account grows slowly, or does not grow at all for months, the trader does not blame the expectation. They blame the method. They abandon good systems too early, chasing something faster, something louder, something that promises more. One decision. One unrealistic dream. One destroyed sense of patience. Take Ariana, a former marketing executive from Toronto, who left her job after 8 months of trading Forex on a demo account with impressive results. She had read that professional traders make consistent monthly returns of 20, even 30%. Nobody told her that professionals who post those numbers are either extremely rare, extremely leveraged, or extremely lucky in a short window of time. Ariana funded a live account with her savings, expecting the same demo performance. Real money changed everything. Her hesitation increased. Her position sizing became erratic. Within 4 months, she had lost 60% of her capital, not because her strategy was bad, but because she expected speed instead of preparing for a slow, disciplined climb. This is where overconfidence enters, often disguised as excitement. A trader wins 3 trades in a row on gold, on XAUUSD, and something shifts internally. The wins feel earned, deserved, permanent. Confidence is useful. Overconfidence is a loaded gun pointed at your own account. Consider Marcus, a prop firm trader from Chicago who passed his evaluation on his first attempt trading gold during a volatile news week. He felt invincible. He increased his lot size without adjusting his stop-loss logic. He believed his read on XAUUSD was special, almost intuitive. 2 weeks later, a single unexpected Federal Reserve statement sent gold spiking against his position. He held on, certain the market would reverse in his favor, because it always had before. It did not. His funded account was gone in 11 minutes. Overconfidence does not announce itself as arrogance. It whispers as certainty, and certainty in markets is often the last thing you feel right before you are wrong. This leads naturally into emotional decision-making, the invisible hand behind almost every blown account. Markets do not care about your feelings, but your feelings will absolutely dictate your decisions if you let them. Fear tightens the chest and forces traders to exit winning trades too early. Greed loosens the mind and convinces traders to hold losing trades far longer than any plan allows. The market psychologist Mark Douglas once explained that consistent trading requires thinking in probabilities rather than certainties, treating each trade as one of many, not as a single make or break event. Most traders never absorb this lesson because emotionally every single trade feels like it matters completely. That emotional intensity is the enemy of clear thinking. Lack of discipline is what happens when emotion wins the daily battle against the trading plan. A trader can have the best strategy in the world, back-tested, refined, statistically proven, and still fail. Because on a Tuesday afternoon, tired and frustrated after 2 losses, they take a trade that violates every rule they wrote for themselves. Discipline is not motivation. Discipline is doing the boring, correct thing when every emotional impulse screams to do something else. This absence of discipline often births overtrading, the silent account killer. Traders convince themselves that more trades mean more opportunities to win back losses or accelerate gains. In reality, overtrading is often just anxiety wearing a business suit. Consider Devon, a Bitcoin trader from London, who during a highly volatile BTCUSD week placed over 40 trades in 3 days, most of them impulsive, most of them contradicting his own strategy. He was not analyzing the market anymore. He was reacting to it, chasing every candle, every spike, terrified of missing the next big move. By the end of the week, his account was down 34%, not because Bitcoin crashed, but because he never gave a single trade room to breathe before jumping into the next one. This naturally connects to revenge trading, perhaps the most emotionally destructive pattern in all of trading psychology. A trader loses a position. The loss does not just hurt financially, it hurts personally, like an insult. And instead of stepping back, the trader immediately re-enters the market, often doubling position size, trying to force the market to give back what was lost right now immediately. One decision, one emotional reaction, one destroyed account. This is exactly what happened to Priya, a former funded prop firm trader from Sydney, trading gold aggressively after a $2,000 loss during a London session breakout. Instead of closing her platform and reviewing what went wrong, she reopened a position twice the size within 4 minutes, convinced the market owed her a correction. Gold moved against her again. She doubled down once more. Within 40 minutes, an account that took her 3 months to build was completely liquidated. Revenge trading is not a strategy. It is grief disguised as aggression, wearing the coat of confidence. Underneath almost every failed trader lies poor risk management, the silent structural flaw that eventually breaks even a good strategy. Risking too much per trade, ignoring stop losses, averaging down into losing positions without a plan, trading without ever calculating maximum drawdown tolerance. Paul Tudor Jones famously emphasized playing defense before playing offense, understanding that protecting capital always comes before growing it. Most retail traders build their entire approach backwards, obsessing over entries, ignoring exits, and almost never respecting position sizing as the true foundation of survival. Then comes impatience, the quiet killer that convinces traders the market must move now, on their schedule, according to their timeline. Impatience causes traders to force trades during unclear conditions, entering setups that do not meet their own criteria, simply because sitting still and doing nothing feels unbearable. Ed Seykota once explained that the elements of good trading are cutting losses. Cutting losses and cutting losses, a principle that requires extraordinary patience to actually follow, because patience is emotionally uncomfortable in a world that rewards constant action. This impatience often merges with fear of missing out, the psychological trap that convinces traders every rally, every breakout, every headline move must be captured immediately or lost forever. FOMO does not ask whether the setup is valid. It only asks whether everyone else seems to be making money right now. During a sudden BTCUSD rally past a major resistance level, thousands of traders enter late, chasing green candles, ignoring their own rules, because the fear of missing the move outweighs the discipline required to wait for a proper pullback. Most of these late entries become the exact liquidity that fuels the reversal. FOMO does not just cost money. It costs identity, because traders begin trading based on other people's excitement instead of their own analysis. Closely tied to this is greed, the emotion that convinces a trader with a healthy profit to keep holding, keep pushing, keep risking, because enough never actually feels like enough. A trader of $3,000 on a gold position refuses to take partial profits, convinced the move will continue further, and watches the market reverse completely, turning a winning trade into a losing one. Greed does not announce itself as greed. It disguises itself as vision, as belief, as conviction. Then there is inconsistency, the pattern that quietly destroys traders who otherwise show real potential. One week they follow their strategy with precision. The next week after a rough emotional day, they abandon it entirely, switching approaches, switching time frames, switching entire trading styles, chasing whatever seems to be working for someone else online. Ray Dalio often speaks about the power of systemizing decisions to remove emotional inconsistency from the equation, understanding that unpredictable execution destroys even statistically sound strategies over time. A strategy only works if it is followed the same way, trade after trade, month after month, without emotional negotiation. This inconsistency is often fueled by the illusion of easy money, the seductive lie that trading is a shortcut to wealth rather than a demanding skill built over years. Social media amplifies this illusion relentlessly, showing highlight reels of winning trades while completely hiding the losing streaks, the blown accounts, and the months of quiet, grinding preparation behind every success story. New traders enter the market expecting speed and are blindsided by how slow, how humbling, and how mentally demanding real skill development actually is. And when small wins do start appearing, a dangerous new trap emerges: lifestyle inflation. A trader withdraws a modest profit and immediately begins upgrading their life around it. New equipment, new subscriptions, even quitting other income sources prematurely, based on inconsistent early results that have not yet been proven over enough time or enough market conditions. This premature lifestyle expansion creates enormous psychological pressure to keep performing at an unsustainable level, which often pushes traders straight back into overtrading and revenge trading, the exact patterns that destroy accounts. Beneath almost every one of these failures lies one final, quiet, unglamorous cause: the lack of journaling. Traders who do not track their trades cannot see their own patterns. They cannot notice that they consistently lose money on Friday afternoons, or that they overtrade after a losing streak, or that 70% of their losses come from a single repeated mistake. Without a journal, every mistake feels isolated, forgivable, forgettable. With a journal, patterns become undeniable, and undeniable patterns are the beginning of real change. And underneath everything, threading through every single failure we have discussed, lies one core missing skill: the inability to think in probabilities. Most traders think in outcomes. Win or lose, right or wrong, this trade or that trade. Professional traders think in distributions, understanding that any single trade means almost nothing. But 100 trades executed with the same discipline reveal the true edge of a strategy. This shift from needing to be right on every trade to trusting the process across many trades is perhaps the single most important psychological transformation, separating consistently profitable traders from the 95% who never make it. Jesse Livermore once observed that there is nothing new on Wall Street, because human nature never changes, and that single sentence explains almost everything we have covered tonight. The charts change. The assets change. Gold becomes Bitcoin. Forex becomes prop firm evaluations. But the human being on the other side of the screen remains exactly the same, still vulnerable to fear, still seduced by greed, still capable of destroying months of progress in a single emotional decision. So where does this leave the trader still reading this, still watching this, still holding on to the hope of financial freedom through the markets? It leaves them exactly where every trader who eventually succeeds once stood, at the uncomfortable realization that trading was never primarily about market analysis. It was always primarily about self-mastery. The traders who survive long enough to become wealthy are rarely the most naturally talented, and they are almost never the luckiest. They are the ones who learned to sit quietly through boredom instead of forcing trades. They are the ones who took a 2% loss without needing to make it back immediately. They are the ones who wrote down every mistake and actually studied it instead of repeating it. They are the ones who understood that consistency, built slowly, protected fiercely, and repeated relentlessly, is worth infinitely more than one spectacular winning month followed by a catastrophic account blow up. Wealth in trading is not built through talent, and it is not delivered through luck. It is built quietly and unglamorously through discipline practiced when no one is watching, through patience exercised when every impulse screams to act, through emotional control maintained when the account is either soaring or collapsing, and through consistency repeated so many times that it eventually becomes identity rather than effort. The market will always offer the fantasy of easy money. It will always tempt with FOMO, seduce with greed, and punish with revenge trading. But the traders who last, the small percentage who eventually build real, sustainable wealth, are the ones who stopped fighting the market and started disciplining themselves instead. If tonight's story reflected something you have lived through, some version of Ariana's overconfidence, or Marcus's certainty, or Priya's revenge trade, or Devon's overtrading, know that recognizing the pattern is the first real step toward breaking it. This channel, the Trading Library, exists for exactly this reason: to explore the psychological battles that no strategy course ever teaches, the internal war that determines who actually survives long enough to become skilled. If this resonated with you, consider subscribing, because the next episode goes even deeper into the mind of the trader who finally breaks free from these patterns, and what that transformation actually requires.